So at the beginning, what I did, at the beginning, I opened up my broker. I will talk in the future about which broker I have and which one would be better to use. I opened a broker and I started investing in an ETF of the S&P 500. So if you're not familiar with an ETF, it's basically a basket of stocks, which include different companies of a particular index. The S&P 500 is the most important index in the world because it contains the 500 biggest company in the United States. If you are invested in the S&P 500, it's like saying that you're invested in the 500 biggest company in the US. I think for many people this is very familiar, but for many still not. I meet many people today that when I say the word S&P 500, they think it's a Formula One car or something like that. No, it's like if you own the S&P 500, you own Apple, Google, Visa, Nestle, Johnson & Johnson, Tesla now. So you own the biggest company in US, which 90% of them are also the biggest company in the world. So I started simple with the S&P 500 and I invested, lucky for me, in the January of 2019. And I didn't know anything. I was so... stupid, I would say, that I didn't look at the charts. I was just wanted to try. And lucky for me, January 2019 was the bottom of a small bear market that started in December 2018 with a 20% drop of the S&P 500. So the moment I invested, the stock shooted up for the following 2-3 months and I made 30% return. At the time I invested a very little amount of money. I didn't know much. I wasn't sure, so I just didn't want to risk. But making the 20-30% made me think like I was a genius, like why didn't I do this before? And of course then some shocking moments started with the tweet of Trump, China-US trading war, and the stock market went bumpy from May till September. And I was like really nervous about this because I didn't see my value anymore going up, was going up and down. I was not really enjoying this ride. And then it started keep going up again in September. As we know, it went up until the 3,300 values in March this year. But in March, I realized that this is something good. This is something that everybody should do, invest in the S&P 500. But it was starting to feel like this approach that I had was too conservative. It was a bit too boring, I would say. Like, this is perfect if you don't know much about the stock market, you're scared about investing, just put your money in the S&P 500. Just every month add a percentage of what you want to invest, and you don't have to think about anything anymore. It's going to be passive and it's going to go up in the future. But it was getting a bit boring for me because I wanted to research stock. I wanted to understand more this world and find better opportunities in the S&P 500. So what I did, I was to start researching stocks, and I came up with some interesting stock that I wanted to pick, and I started to buy them around February when there was still the high. And then we know what happened around 24 of February. The virus started spreading in North Italy, and we all know with the big crash of March where we went. I of course sold before the crash happened, but that moment was like kind of an awakening moment. It was like, this is the time to stay calm and wait for the bear market to reverse and put your money in. But which strategy did I think to use at that time was still different from what I'm thinking now. So at the beginning I was like, wanted to go all in Tesla, but I wasn't so sure about it because the volatility of the stock was extremely high and was scaring me. So then I thought maybe I should keep being conservative, but maybe I can do something conservative and at the same time fun. So I went into dividend stocks. So I thought about why don't build a dividend portfolio, as many people are doing that. And I started investing in dividend stocks. And I started investing around the 1st of April. So you can see here, this is my performance chart, again, the S&P 500 till today. And as I started investing in this dividend stock, the price started to shoot up because we were in a bullish market now. So we were going so oversold that was the time to buy stocks. The time passed by. We had like a nice April, nice May, and then June arrived and we had this high, big peak. And at this high peak, I thought like, this is great, this is going awesome, but there were a lot of warning signs that this would have not last forever. And in fact, we had in June this big retracement down, and my portfolio actually suffered more than the S&P 500. And I started to realize that there was something was going wrong with my portfolio, which was the fact that I invested in stocks that were recovery stocks. So most of my dividend stocks at the beginning were stocks that would have not functioned well during a pandemic, but only after the pandemic was over. So the S&P 500 is composed mostly by tech stocks that are shooting up during crisis. And that's why my portfolio against S&P 500 started to diverge, which have very, very big divergence around the 31st of August, when we had the peak of Apple and Tesla. And I had a peak down, basically. And so I wasn't really nervous about it. The fact that this was getting big, I was just a bit frustrated that S&P 500 was going so high, but my portfolio was not developing so well. But I knew that this, over time, this will change, because most of the stock that I have didn't recover to the March high, while S&P 500 is 10% over this March high. So I kept investing and I kept adding more and more stock. But my philosophy at the 31st of August started to change. I started to switch from only dividend stocks to also growth stocks. Because I think that to have a balanced portfolio, to create a structural portfolio, it's important to be if you exactly want a balanced portfolio, you have to be balanced. So you have to be balanced in all the investment categories that you want to add in your portfolio. So I see many portfolios in which people only go all in growth stocks or in penny stocks or only dividend stocks, which is, I think, most important thing is to focus on what fits you, what is best for you. But a portfolio like this, it's always too much diverge in one direction. So if something happened in that moment, in that particular direction, like pandemic for dividend stocks, or like the end of the pandemic for tech stocks, this will hurt you a lot. So I started to think that maybe I should combine dividend stocks and growth stocks together to create a portfolio which is more balanced, which gives me capital gains, but also dividends. And at the same time, fun to understand. So my current portfolio structure is basically composed like this now. I have 57% of my holding in growth stocks and 43% of my holding in dividend stocks. And I will go through it in a moment. What I would like to say first is that this is a portfolio which I maintain in euro, because since I'm a European investor, I'm based in Germany. My interest is to have the returns in euro. In fact, one of the most important things that people in Europe sometimes miss is that it's great when the American stock goes up, but if the most important factor to keep in mind is that the Euro USD exchange, it's not static. It's not always 1.1 or 1.2. It changes over time, and this can hurt your returns a lot. And I will show you in a few moments why. So before going through my portfolio, I would like to say, if you're interested in this kind of topics, if you're interested to build your own portfolio from scratch, if you don't know how to start, or you feel like everything is overpriced right now, or you feel like it's a too scary world for you, leave a comment and I will try to make this as most simple as possible to explain and guide you through this process. So as I said, my portfolio is combined by growth stock and dividend stock. This is, of course, is not all my net worth. I have also other assets, but the most important thing, when I have, like, if I look at the 100% of my asset, 15% are always cash. I always have 15 to 20% in cash, because cash that I don't touch for investment, cash that I keep in case I have some emergencies, because you never know when you're gonna need the money for any particular reason. And while yes, stocks are liquid assets, you still need time to, you don't want to sell your stocks, right? You don't want to sell your stock while they're doing amazing gains, while they're giving you a dividend, and anyway you have to sell them, transfer to a bank. It's anyway time, and sometimes you need the money right now. So I always keep 15 to 20% of my money in cash. Then the rest 80% of my money I don't keep into the bank, exactly because of the chart that I showed you before, and I invest them. So ideally you would like to have like your kind of level of risk. So my level of risk allows me to put more money into growth stocks than dividend stocks, but it depends on you really. Like if you like to have more dividend value stocks, then do so. If you like to have like not single stock but mainly S&P 500, do so, but try to be more invested, to have your money more in the investment side and in the savings side. So we will continue in the next video with how I started investing. Thanks for watching. See you soon, guys.